Hi, I'm Justin Reid. I'm the CEO of Troilus Gold. We're located in northern Quebec. We are developing the Troilus Gold and copper asset, 13 million ounces equivalent in the development stage.
Justin, good to see you again, and happy New Year to you, sir. Right, we want to get into this because a lot of pushback in the market, and not a lot of love for the sector last year or the year before that, it seems. But it's now kind of make a break for a lot of companies. There are seem to be a couple of handfuls of advanced development stories in Canada. You're one of them. How do you guys stand out?
I think, like you said, the market was volatile. Capital was difficult. What we were able to do last year was not slow down. You see a lot of starts and stops, slowdowns. We remained on track and just kept moving forward, mainly because we remained well capitalized. And that goes back to our institutional shareholders, 70% institutionally held. Capital's been available to us. Obviously not happy with the share price performance at all, but we're able to proceed. And I believe we're going to continue to de-risk. I see us in a really good spot right now, well advanced on permitting, well advanced on team and execution. We're now moving to pre-development work, not exploration work. And we're putting the pieces in place to close the financing to build this asset. So I think we're in good shape.
Okay. You're doing that in a market which is seeing mergers of equals, but unfortunately mergers of producers. Not a lot of new ounces being funded at the moment. So what is the timing for this? Because at some point we're going to need to see new gold ounces. We're going to need to see new copper pounds come in here. But right now the majors are taking the easy route.
Yeah, I don't know what the timing is for that. I mean, for us though, the consolidation is continuing, and like you said, starting from the top and is working its way down. Well, the middle is consolidating now. So there's only so many moves left, and eventually you're going to have to move towards the development ounces. And the development ounces that are going to be looked at are ones that have impact. It's not going to be the 50,000 ounce producer or the 100,000 ounce producer. Majors don't care about that. Who's going to produce 300 to 500,000 ounces a year for a long life? And there's, like you said, there's a handful that are moving those type of assets forward. And I think we're probably sitting towards the top of that rank right now.
Right. Okay. And just sticking with this thematic, I kind of want this conversation to be around the kind of reality of the economics and what you're going to need to do. So, look, you put out the study in the last year. It's going to mix I guess reviews. What certainty do we have around the I guess efficacy of the numbers that you put together, the ability of that plan to actually be delivered? Because when the majors look at stuff like that, they're going to view it through a slightly different lens, presumably. So, what have you got going for you in that regard?
You're absolutely right. I mean, we saw some major blowouts at some major developments, and that was a result of building mines during an inflationary window that was just skyrocketing. It was moving, 5% a month. You couldn't keep up with it. We had a couple things going for us. We put out our feasibility coming out the other side. So I would say that we fully baked in the impact that others were feeling in real time at Cote, Magino, and others. Our technical committee, led by Eric Lamontagne, was building Greenstone at the exact same time. And they did a really good job there. Equinox did a spectacular job putting that mine into production. So we had on time, on budget. So we had real-time data feeding from a real-time exercise into our feasibility. And that was reflected in our feasibility that we put out that gave us an 18% IRR at sub $2,000 gold prices. And the market said, oh, we don't really like that. One, we think your IRR is too low. But when you go back and you look at Greenstone, Malartic, Detour, Cote, low-grade bulk tonnage deposits are capital-intensive upfront, but they're cash flow machines once you're into production. They give those type of IRRs. Now, you look at today, we start playing with $2,700 gold or $2,800 gold. That IRR goes into the 30s. So it's all relative. Our timing's great. But I would say that we believe we put forward very solid numbers. A huge amount of external DD has been done on them, and we've kicked off detailed engineering with BBA right now to move to the final engineering for the build. They did Detour, they did Malartic, they did parts of Greenstone. We have the A team there. We have a lot of confidence going forward. Absolutely still exposed to inflation, though, for sure.
Yeah. Okay. Well, let's kind of look at some of the problems that they will have tried to solve for. Price and inflation is probably something out of my scope's control. So, if I look at the size of the project, it's a big project, and eventually, a lot of ounces coming out of the ground, or ounces, pounds, however you want to measure it, depending on what you're going to be focusing on. Early stage versus long term. You've got a 22-year life of mine there. You kind of advertise a 1109 ounce ASIC there, but how do you structure something like this at the front end? Because you've got a 5.7 year payback. It's one of the numbers that you put out there. That's a long time. You've got to wait for year 7 before you start making money effectively. Free cash flow is a long way out. So how do you come at the project to maybe adjust, improve, make it more efficient, however you want to look at this to make it more attractive going forward?
And at $2,500 gold, $2,600 gold, we're under 3 years, right? So certainly I'm not going to downplay the impact of commodity prices here for us right now. Our timing is great. And if we go through $3,000 gold, which you never know, we could very shortly here, you can hedge at $3,000 gold right now. And if you start locking in prices, even Troilus could, you start locking in $3,000 gold, you basically guarantee your cash flow, you guarantee your payback, you take a huge amount of fiscal risk out of it. Yeah, I think I think from our standpoint, we're moving into detailed DD for our financing package, which we'll talk about. That model is getting stress tested by an unbelievable number of external experts that I won't even go into, the working groups that we have, but how we can make it better. You want to have flexibility at your operations up front. We are refining the mine plan. We've already made our first 2 years of production in our mine plan from our feasibility better. You add a little more pre-strip in, you get some higher grade. So I believe we're going to be able to update, and this is going to be internal, but we're going to be able to update the mine plan to look better for the first 3 years. A feasibility is a moment in time. It's, hang on, we've done a whole bunch of work. Let's tell the market what our economics are, how much it's going to cost, and what our mine looks like. You go into detailed engineering, where you're talking about every shovel load of ore going through that mill and when it's going through. The cost of detailed engineering is 4 times what a feasibility cost. We are already seeing massive improvements. So any improvements, a 3, 4, 5% increase in grade, a 3, 4, 5% increase in throughput, backed with the commodity prices that we have, this turns out to be an incredibly good operation.
Okay, I think you've got a ton of money to raise. You got the kind of capex and opex, and for the early years of ramp up, etc. And maybe some of the money you've been talking about with me in the past is a little bit less price sensitive, cost sensitive, or even risk sensitive, in the sense that you've kind of plugged into a lot of Quebec-based institutional money there. You're still going to have to get some external money outside of Quebec. Those guys are going to be looking to you to kind of de-risk these things. You mentioned some of the things that you'll be focused on, but labor, energy, equipment costs continue to be, I guess, problematic in terms of trying to pin those down. So can you get into maybe what the first three years looks like once you are FID? What at FID stage? What do you tell the market? What do you tell those big ticket riders?
Before they write those tickets, they've already signed off on the plan. And it's not really the economics. Troilus's economics are exceptional. At $2,000 gold, we're going to be generating over 150 million US a year in free cash flow. At today's prices, it's closer to 300 million US in free cash flow because all your costs are sunk in there. It's about execution, to tell you the truth, and going through the DD process like we are right now. The financial model's already signed off on. You're not getting LOIs. You're not moving into mandated terms until the model's signed off on. The biggest focus from the lenders and the capital providers now is who's going to do it? Have they done it before? What are the major risks to execution, to equipment, to people, power, all of the things you talked about? How have they been mitigated? And what is your execution plan? And it's a really different thought process than even I was used to, where I'm about, let's get the economics around this, let's raise the money and go. I mean, I'm actually going to say the money is not as hard as you think it is. It's putting the right people in place and the execution of this, because there's lots of projects to be built. Who's going to do it, and have they done it before? Because delays increase your cost of capital, so don't delay.
Okay, well, let's come to that. Let's come back to that in a second. So I want to come back to on the kind of free cash flow and how you view management of a balance sheet, because you're going to have to talk to that, because that's, you know, the way that you set up on the corporate side affects your kind of business plan and strategy, and then people putting the money in need to be, you know, clear, you know, about things like, you know, free cash flow and how you treat, you know, leverage, how you you know, treat capital. So how are you planning this out of the future if, you know, if you're still around when this thing gets built?
Sure. So let's assume a $2,000 just gold price and $4 copper, because I can talk about leverage all the time and gold's at 3,000. A lot of your problems disappear. How much can this project actually take in debt? You know, we have right now 1.3 billion in offers from major ECAs around the world, Germany, Finland, Sweden, and from Export Development Canada. We're not going to take $1.3 billion in debt. I mean, our CapEx is 1.07 billion US. Let's say there's some more inflation in there, so it's 1.2. So if we solve for 1.2, we believe that this project can handle between $700 and $850 million in debt reasonably. Based on our cash flow models, that's going to give you a debt to service cover ratio of about 1.9. The covenants that your banks are going to ask for is about 1.2. So that means that we are left with quite a bit of flexibility between 1.2 to 1.9. Should inflation hit, CapEx goes up, delays occur, cost of capital modifies, what have you, we're going to overcapitalize and leave ourselves room for flexibility so that a lot of the problems we've seen in the past hopefully don't impact us, because in previous examples that we've seen over the last 5 years, what that typically means is impact to equity. By leaving yourself room on the debt register for flexibility, you basically are protecting the equity to the best of your ability. So that's one thing. So great. So you have $850 million in debt. Where you're going to come up with another $300 to $400 million Canadian. We have something going to, and all of that debt is tied to, I'll explain it as a pyramid, first of all. The ECAs form the foundation of the pyramid, the majority of the debt capacity. Over top of that will come commercial banks, who actually execute or facilitate the transaction. I've been getting a lot of questions about how does this roll out. When we identify the commercial banks, which we're getting very close on, they will take all of these LOIs into a mandated debt package, and those LOIs convert into tangible commitments, if you will. And that's going to happen very soon for us. In the middle of that pyramid is a little bit of room for our institutions who play the debt space to participate as well. And most likely you're going to see our Quebec institutions fill that in. And so we're well advanced there, converting those LOIs to tangible mandated commitments. And we'll deliver that very shortly.
Let's explain to people, listeners, viewers, readers of this, the difference between an LOI, letter of intent, versus what you're using the phrase of tangible actually means in financial terms.
So the LOIs are spectacular because they give us essentially the collateral to move forward and say, we're 90% of the way there. The LOIs basically are saying, if you deliver concentrate to Arubis in Hamburg, which is their biggest smelter, the German government will give you $500 million in sovereign debt.
So these are binding LOIs, you're saying?
These are binding LOIs should we sign an offtake agreement. We have to go back and sign the offtake agreements, and we are doing that right now. We're negotiating with Arubis, with Boliden, and with Glencore. The three homes where our concentrate is going to go, we're actively negotiating right now. And are we going to put 60% of our concentrate into Germany? No, we're probably going to put a third of our concentrate into Germany. So that 500 comes down. Are we going to put 50% of our concentrate into Scandinavia? No, probably a third, and that's going to come down. And a third will probably stay domestic.
Does it surprise you that you're ending up talking with European finance partners versus North American?
No.
What's happened?
Well, I got to tell you, it's not the gold. This is 100% based on copper.
I understand that. But
copper is going to fund this. Gold's going to drive the value. I've said that is a bit of a tagline now, I guess. But we meet all the critical minerals definitions. We do. There is a desperation in the refining world for copper con right now. At Arubis, 20% of their con was fed by Cobre Panama. It's gone. There is not new copper production coming on, especially copper concentrate production, because cathode doesn't do anything for the smelters, that will fill that. Boliden is going through the exact same thing. And then when you look at the Horn smelter, well, the Horn smelter has lost Kid Creek. It's lost all the Flin Flon assets, or the majority of them. A lot of development that was supposed to be happening hasn't been happening or has been delayed. So these smelters are now relying less on concentrate and more on recycling. And so the more recycling you put through, you're throwing more plastics, and the more plastics you throw in with the recycling, the more emissions come out. So you need concentrate, you need primary concentrate. And so our timing's really well, because we're filling a massive gap that they have. They've lost the 6th largest copper mine in the world that fed those smelters, and some of them up to 25%. So for us, there is demand. Now, our copper also meets the political objectives of the European Union. And so it's very easy for us to get there. These smelters took the Troilus concentrate previously, so they know it, they understand it. There's a pre-existing relationship, and their government is stepping up. But the Canadian government is stepping up too. EDC has matched the terms of everybody else, because that's our trading partners, and you'll see Quebec shortly. So yeah, it's great. If Glencore would finance $1 billion, we would probably keep everything in Canada. But we're going to the cost of capital. Also, the flexibility of capital. Yes, we sign a 15-year offtake with, and we probably won't, but if we sign a 15-year offtake with Arubis in Germany, we get 15-year money. That's spectacular. If you can amortize something over 15 years. But the European governments are very, very aggressive to drive imports into their country right now. And for us, it's super easy. And
but I would expect the US to have been talking the same game, but it seems to have been more talk than action for the last 4 years. Look, in talking the last 4 years, it's not been a pleasant time for anyone, really. And you're conscious of your share price. It's not where you want to be. You said that at the outset. How do you play this initially? Because you're going to have one eye on what's happened for the last 4 years and one eye to kind of drive that share price up. You also got to manage this balance sheet and this activity and this build period, and without reverting back to when maybe if gold's 3,000 or if maybe if gold's 20 stays at 2,700. It says what do you actually do in terms of the way you allocate capital? You talked about free cash flow earlier, and how you what you do with that. So how do you play this? And does the past or recent history drive that thinking?
Yeah, I mean, we're entering an expensive period, right? We're detailed engineering is expensive. Building out the team like we have is expensive. Permitting is expensive. Drilling was expensive, but we're really not drilling like we did. So it's kind of one replaces the other to a certain extent, right? We don't have 7 drills turning now. We have 1 drill turning. But with that, it's about managing your balance sheet and what parts of the future financing that's ultimately going to build your mine can you lever early as well, which ideally negates massive dilution to your shareholders, but allows you to keep you on track. And I'll talk on a standalone basis. There's other discussions that can be had about partnerships and everything else. And I honestly, all of those things persist in parallel. But for us, we haven't got the equity value. So why does Troilus, if we're able to fund this and we're able to put the best team forward and actually execute this, we don't want to start selling pieces or ourselves down at these levels. We've been talking for 5 years. We were going to play this out properly, and you can build a spectacular cash flowing asset. So to your point, our balance sheet's in great shape right now. We're sitting with mid-20s. The last financing hurt on a dilutionary number, but it's set us up to execute everything that we need. We're seeing different sources of capital all the time. I almost got hung by my shareholders in September of 2020 when we bought back a 2.5% royalty from First Quantum for $20 million. Probably the single best move we've ever made in hindsight. Not only the impact to the model, but the flexibility that it gives us. So we'll move the debt package forward. We have a lot of optionality on royalties and streams for Troilus going forward. And we've spoke about it before. We're going to produce between 600,000 and 1 million ounces of silver a year. Silver stream alone is worth about $100 million and accounts for less than 1% of our total revenue. That has no impact financially on us, really, and it has no impact strategically on anything we want. It's an asset that we can actually look to monetize early. If you want to start talking a little bit of gold in that as well, the numbers grow exponentially to $200-300 million, where all of a sudden we can start seeing some prepayments up front and participation. And you bring you bring capital into Troilus that way, all of a sudden we're well funded kind of to the end. And also you fill in that piece above the debt, well, structurally on the balance sheet below the debt, that gets you to the end. And then you have a number of critical minerals funds, mainly European-based again, that are actively writing significant checks from equity, pseudo-equity, pseudo-debt that will help fill the gap into the end. And that's without even going back to our existing institutions that we have, who have all been there because they know the game, they know what we're going to play out. So I believe we're going to remain well capitalized to get us where we need to be. And I believe that we're going to be able to have this financing package closed in Q4 of this year. And, on a permitting side, everything kind of lines up well. Okay.
So just be clear, because I think you're starting to touch upon some of the things that I want to go to, which is like on an enterprise basis, you're not being valued at all. Well, not at all. You're not being valued anywhere near where you think you need to be right now. So obviously people are saying to you, right, one, I don't think you can get this thing financed. 2, I don't think you can get this thing permitted. 3, I think it's low grade, or whatever the discounted factors are, which put you in this position. What are and you've got a long list of things that you're going to do this year, detailed engineering, et cetera, and deep watering and ESI, et cetera. What are the things that you think will remove those kind of discounted factors, and what's that kind of process look like? So in a few months down the line, you can turn back and say, look, I told you we'd do that. We've done those things, and you should value those things certainly a lot higher than you currently are. Was that, again, come back to your line of, well, it depends what the gold price is doing. It depends what the markets are doing.
I don't think it depends on the gold price, and I don't think it depends on the market. I think it's on Troilus, to tell you the truth. This is about, and we've talked about this before, these assets, it's about steady technical de-risking, eliminating the questions that you just brought up. So let's start from the project and we'll end at the financing, because I think at the end of the day, the financing is the biggest question, to tell you the truth. Technically, let's talk about permitting. Our ESIA, the submission process has started. We have a great handle on it. We did it when we said. It's run by Jacqueline Leroux. I have zero worries on that.
That went in yesterday. So what's the timeline? What's the timeline?
We believe we can have everything in place in the first quarter of 2026. So 1 year. Okay?
Gotcha.
Now, the dewatering might not seem like a big deal to many people, but we're moving 30 million cubic meters of water out of the pits into the environment. And right now, we're not treating it. An EIA has already been completed for that. Consultations are done. We are dewatering with our Cree partners' oversight. And the single most sensitive issue in any mining operation in North America or the world is always water. So the fact that we're moving 1,500 cubic meters an hour into the environment really shows you we already have political support, social support, and that our permitting process is moving well. If we didn't have that, we would not be moving the water right now, full stop. And remember, we're a brownfields permitted site. So it's not like this is new disruption. We keep the same footprint. So I would say technically, the permitting risk for me is low. It needs to be managed, and it's still North America. So it's bureaucratic. You have to do things right. It takes time. And will there be a time delay? I'm sure there will. There always is. We think we have a good handle on it. Then we go to the engineering and technical risk. Well, we've just brought in Andy Fontaine as our operations manager. Look at his bio on our website. I'm not going to read his bio for you, but he's built and operated 5 mines through Quebec, incredibly well known, and a team comes with him who all have experience at Troilus as well. Probably even more importantly right now, we just hired Denny Rivard, who is going to started last week. He's your hired gun. He's leading the project development. He's coming in for 4 years, engineer, build, operate, hand to Andy and his team to operate. Denny built all of the aluminum smelters in Quebec, the largest aluminum smelter in the world, 7 or 8 gold mines, ran BBA as a partner, which is one of our detailed engineering firm that we have hired. And one of his last roles was the head engineer at the Case, which is one of our largest shareholders, the largest pension fund in Quebec, and he built the large metro extension for them. So again, our project development team, best in class. So from that side, I'm working with BBA, who has done this so many times and have learned from mistakes, but also engineered mines as stuff. Technically, we have the permitting in hand, and I would say we have the execution in hand. Our lenders and our lending group know these people, know these groups, and say we're very comfortable with them, and hence why we have hired. So then, that's great. We have a brownfields operation. We have a huge amount of infrastructure in place. Ideally, that's going to keep our capital low. It's over $500 million in savings. And then it's what's the other big risk? The other big risk, and we've been talking about a lot, is financing. You're going to see mandated debt from us. So those LOIs will convert to mandated term sheets. We look to close those, like I said, in Q4. We have time. We have other options available to us. The cost of capital from the other options typically is significantly higher. The moment you start bringing private equity in, and we've seen it, and actually we've considered it, your cost of capital can be upwards of 2 times what we potentially could pay. That has a huge impact on the amount of debt that you can carry based upon your cash flow profile. royalty streams, equity, pseudo-equity, that financing above the debt we're working on now. And I think we can have a lot of those pieces cleaned up, if not sooner, certainly in line with the project debt. So in an ideal world, we'll keep delivering all of the things. We'll be updating the market on all of these advances. We're checking the boxes. If you look at our last 8 press releases, they are all about forward movement on all these fronts, and we're going to continue to do it. But it's in our hands. What I would say is the last equity raise we did, it was almost a rights offering. All of our large institutions came in pro rata. What is the plan? Are you executing the plan? We agree with your plan. Here is the money. And they haven't left. So, and I think you'll see some new ones shortly. So, yeah, we have the team, we're capitalized, we have the market, we have to deliver, and that's what our focus is for the year.
Right. Well, I guess for those investors, they can't be half pregnant on this one. They've got to believe that you're going to get this thing over the line. I guess that the final question I'd ask, and they probably asked you, which is sort of what I asked you earlier. It goes to how do you get to the front of the queue? If you look at there are a couple of slightly more advanced developers, is there room for all of the above? Is there going to be enough demand?
I think so. You'll start to see some are incredibly well priced right now. And they've had, especially those who are pouring gold now or about to pour gold, I would say the appreciation of their equity has done incredibly well. You're now going to be tied to really the gold price, and it's going to be about delivering. And starting a mine is a whole nother conversation about how difficult it is. You can get it built, you can pour gold, you can do all these things, but then operating it, controlling your costs and everything else is, it takes years to get a mine perfect. So I think you're going to see a lot of capital move from those who have delivered their projects. The reward or the return has been recognized, and it'll come to the next one. And we've actually, and you'll probably see it from us in the next few weeks, we're seeing a number of large funds starting to do that directly. And as such, we're spending a lot of time talking to them about our execution plan.
Okay, just changing hats slightly. If you can take your mining hat off and put your finance hat on, obviously, since I last saw you, Trump's in market. I think there's lots of people trying to work out how they play what they see in front of them. In the context of gold and some of the commentary around FX and geopolitical tensions, so we say, how does gold play out this year? It's all well and good talking about gold 3,000, etc. But what do you think the drivers now are for gold and its ability to kind of at least sort of stay at or around its current levels?
I don't think it's going to stay at current levels. I mean, I'm talking my own book. I think it's going up. But whether you agree with the new administration in the U.S. or not, I'm not going to ask people their political views. I think one thing everybody will agree on is that there's going to be a huge amount of volatility. Just by definition, there's going to be volatility now. And I think volatility certainly provides a positive impact on gold. It typically does. U.S. dollar is still very strong. I cannot see how the U.S. dollar is going to continue to stay this strong. And I don't think anybody does. And just look at the gold futures right now. I'm talking spot market right now. I think from that standpoint, I think you'll see gold move through 3,000 with ease this year. Where it normalizes, I don't know. But then when you jump down to Canada, and this is what I care about, gold's over $4,000 Canadian this morning. Great. I think more importantly, though, is what will the impact of the tariffs be on the Canadian dollar? Canadian dollar is already, I don't know, 69 cents or it's incredibly weak. We've been decimated. The Bank of Canada dropped rates yesterday again by 1/4 point, but they did that in the face of potential Canadian inflation should the tariffs come in. And there were some reports coming out from various economists in Canada yesterday that if full 25% tariffs came in, the Canadian dollar could drop another 15 or 20%. I don't know. I'm not an economist. All I know is that it hurts when I go to the States right now on a holiday or to the BMO conference next week. It's costing us a lot of money to go now. But let's go back to the operation. Selling our product in US dollars, our costs in Canadian dollars. Right now, I want leverage to Canadian gold miners who are actually benefiting from the current economy. And I want exposure to developers in that space. Costs are going down on a Canadian dollar basis, selling prices going up on a US basis. That means you have massive margin expansion. That's where I want to put my money right now.
Interesting times ahead in Canada, for sure. Last one, we got Carney or Polyev?
It's good. Well, hey, we have a provincial election first that was called yesterday, or I think yesterday, and then listen. I think a PC government in Canada will take away some of the permitting risk. But from our standpoint, it really didn't matter if it was the PCs or the Liberals, to tell you the truth, because we're Quebec-based. And we're permitting, though we have to go through the federal process follows very, very closely with what happens in Quebec. So I'm not picking whether it's Polyev or Carney or whoever in Canada. We're Canadians at the end of the day. We need to move back to a centralist society, I believe. And one great thing about Canada, no matter who's in power, our mining has always moved forward. So it's kind of irrelevant to me, and I think we're in great shape. I prefer being in Quebec because Quebec leads. So
very politic answer. Thank you.